Torm, a tech, ticker TRMD, missed Q2 EPS consensus today despite a massive top-line beat. Revenue came in at $662.8 million, which, easily topped estimates. But EPS was only $3.25.
Right, missing that $3.90 target by basically 16.67%.
Exactly. And strangely, full-year 2026 guidance actually got upgraded. TCE earnings are expected between $1.4 billion and $1.6 billion, with EBITDA up to $1.2 billion. Even so, shares dropped about 3.9% on the day, down to $30.62.
Well, the market clearly wanted more on the bottom line, right? I mean, they weren't just going to overlook a miss like that just because revenue surged.
Okay, let's unpack this. Because if revenue basically doubled year over year and management just raised their financial guidance, why exactly is the stock dropping? Like, what caused that 17% earnings miss?
So what's fascinating here is the underlying profitability story and, well, the cost attached to it. The top-line revenue is surging because freight rates are really high.
Sure.
But operating a massive shipping fleet on these longer redirected global routes, I mean, that drives up voyage and operating expenses significantly. That extra fuel and time just chewed right into their final EPS number.
That makes sense.
Yeah, but if you look past that bottom line miss, the core metrics are incredibly strong. I mean, Torm is generating a 44.2% return on invested capital.
Wow, 44.2%.
Right, and their net loan to value is sitting at a very healthy 22.4%. Plus, fleet-wide time charter equivalent, or PCE earnings, hit $512 million for the quarter.
So the broad profitability is definitely there, even with those elevated voyage costs. How does that actually translate to their specific fleet operations right now?
It breaks down really favorably, depending on the ship size. Their LR2 vessels, these are the massive heavy hauler tankers of the fleet, they're locking in over $49,000 per day.
Per day. That is wild.
Exactly. And meanwhile, the smaller, more nimble LR1s and MSRs are sitting comfortably in the $32,000 to $35,000 range. So across the board, they are capturing peak spot rates.
Which really gives a lot of context to CEO Jacob Meldgaard calling this the strongest quarter in Torm's history.
Yeah, absolutely.
Looking at this setup, it really feels like Torm is acting as a highly profitable toll booth on a forced global detour, Because of the ongoing disruptions around the Strait of Hormuz, global shipping is just taking the long way around.
Right, they have to.
And Torm is just capitalizing on every extra mile.
It really is a toll booth, but it's one built on a temporary detour. And for anyone holding the stock, what they are doing with all that toll money is the real story here.
What are they doing with it?
They just announced a massive $2.40 per share interim dividend. That represents a 73% payout ratio of their net profit, pushing capital straight back to shareholders.
Now, if you are an income investor looking at that 73% payout ratio, your ears are definitely perking up right now.
Yeah.
But I do have to push back a bit because this whole setup raises a red flag for me.
How so?
Well, have we reached a cyclical top? I mean, Pareto just downgraded this stock to a hold, and GF Value flagged TRMD as potentially 48.8% overvalued. It sounds like Wall Street thinks the geopolitical music is about to stop.
Yeah, that is the big question right now.
So where exactly is the risk hiding in these numbers?
The risk is entirely in those very geopolitical tailwinds padding their margins today. The peak daily rates we just talked about may already be showing signs of cooling off.
Right, because the detour might not last forever.
Exactly. Now, Torm has hedged their bets somewhat. They have fixed about 70% of their 2026 earning days at an average of roughly $45,000 a day.
Okay, well, that is a solid floor.
It is, but that still leaves nearly a third of their fleet completely exposed to spot market volatility.
Which leaves a pretty heavy anchor tied to that sky-high dividend expectation.
Exactly. Since Torm's massive dividend payout and current profitability are so tightly coupled with severe geopolitical disruptions, you really have to ask yourself a question. What's that? How violently will the spot market and this stock recalibrate if those global tensions suddenly ease?
A critical question for anyone looking at this space. Be sure to follow the show for your daily earnings coverage, and we will catch you on the next deep dive.